In this video, we will explore the three major types of trends that shape the economy and financial markets. When we look at economic data, it can often look like a confusing mix of ups and downs. However, if we look closely, we can classify these movements into secular, cyclical, and seasonal trends. Understanding which trend is at play is critical because it tells us if a change is permanent, temporary, or just a yearly routine. Let us start by comparing these three trends side by side to understand their nature and time frames. First, we have secular trends. These represent long-term structural changes in an economy or industry. They are powerful shifts that create permanent displacement in how we live or work, typically occurring once every 7 to 10 years. Next, we have cyclical trends. These are medium-term trends affecting the quantity of goods consumed. Think of these as a wave that goes up and down. They eventually reverse, return, and reverse again, usually flowing in a cycle of 2 to 6 years. Finally, we have seasonal trends. These are highly predictable patterns that happen annually, usually driven by weather or agricultural harvest cycles. Now, let us dig deeper into secular trends. As we discussed, these are long-term and structural. They are often driven by major disruptions in technology, culture, or demographics. A classic example is the digitalization of office space. As technology improved, the consumption of paper and ink went down significantly, while spending on digital products went up. This is not a cycle that will reverse. It is a permanent change in direction. This is what we call an inflection point in the business life cycle. When you spot a secular trend, you are looking at the future of an industry changing permanently. Moving on, let us look at the hierarchy of cyclical trends. These are non-permanent trends that reverse over a period. We can break these down into three specific subcategories. First, at the macro level, we have the economic cycle, which affects the whole country. Second, specific to raw materials, we have the commodity cycle. And third, at a company or supply chain level, we have the inventory cycle. Each of these operates on the principle that what goes up must eventually come down and vice versa. To visualize the economic cycle, imagine a wave pattern. The economy does not grow in a straight line. It moves through four distinct phases. It starts with a boom or expansion, reaches a peak, then drops into a recession and hits a bottom called a trough before starting all over again. The tricky part for an analyst is that while we know the order of these phases, the length of each phase is unpredictable. A boom might last years or it might be short-lived. The dotted line you see in the middle represents the average growth path over time. Let us zoom in on the first phase, which is expansion or boom. This is a positive feedback loop. It usually starts with drivers like higher income, lower interest rates, and high consumer confidence. This leads to high demand. To meet this demand, companies engage in higher production. To produce more, they need more people, leading to higher employment. When more people have jobs and money, it leads to high consumption, which starts the cycle again. Companies plan to expand capacity and consumers buy long-term assets like houses. However, be aware of the side effects. Excessive borrowing leads to higher interest rates, and high consumption often leads to high inflation. Eventually, the economy hits a tipping point, leading to a slowdown. The boom cannot last forever. As we hit the peak, the higher prices and higher interest rates we just discussed start to discourage consumption. Simultaneously, central banks often step in to control inflation by implementing tighter monetary policies, which means raising rates further. The effect is immediate, growth slows down. Consumption might still be rising, but at a much slower rate. Manufacturers who built huge factories anticipating endless growth, suddenly witness lower capacity utilization rates. This slowdown typically slides into a recession. This is a negative spiral. It starts at the top, where low utilization rates force companies to cut their expansion plans. Step 2 is cost cutting, which often means layoffs. When people lose jobs, unemployment increases. Step 3 is that income decreases, which naturally leads to consumption decreasing. Finally, at the bottom, consumer confidence declines. People start saving money to survive rather than spending it. The macro effect of this is that interest rates decline and the inflation rate comes down because no one is buying anything. But this gloom does not last forever. Eventually, we enter the recovery phase. The low inflation allows central banks to loosen monetary policy and inject liquidity into the market. With money becoming easier to borrow and prices being lower, consumers start buying goods and services again. This sparks economic activity. Slowly, the cycle returns to the expansion phase. For you as an analyst, understanding this cycle helps you predict sales volumes and pricing power for an industry over the medium term. Parallel to the economy, we have the commodity cycle. This affects hard commodities like metals and oil. It is often driven by the economic cycle but can happen independently. It moves in 4 quadrants. When there is a supply decrease, prices increase. This leads to the next phase where high prices encourage suppliers to increase capacity. Eventually, this leads to oversupply, causing prices to fall. When prices crash, high-cost suppliers cannot survive and exit the market, leading to capacity abandonment. This reduces supply and the prices increase again, restarting the cycle. Inside the commodity cycle, we have a shorter-term phenomenon called the inventory cycle. This is driven by adjustments made by producers and customers. Think of a seesaw. On one side, if there is huge customer inventory, they stop buying. This causes supplier inventory to pile up and prices fall. However, once that inventory is used up, we hit the other side called low inventory. Suddenly, demand improves and customers need to buy immediately. This rush for procurement causes prices to increase rapidly. A perfect real-world example of this is the crude oil scenario in the year 2020. In April 2020, there was a massive glut of oil. There was huge inventory in places like Oklahoma. Because there was no storage space left, the futures price crashed to around $20 per barrel. And for a brief moment, it even went negative. However, as production stopped and the inventory situation improved, the market balanced itself. By June 2020, just 2 months later, futures recovered to around $40 per barrel. This shows how quickly inventory levels can dictate price. Finally, let us look at seasonal trends. Unlike the complex cycles we just discussed, seasonal trends are highly predictable fluctuations. They are driven by nature, specifically weather or agriculture. For example, the contribution to the gross domestic product from agriculture is always higher during harvest periods. Similarly, retail sales often spike during festival seasons. These happen at the same time every year, making them easy to anticipate. Because these fluctuations are so predictable, analysts have to adjust their math. If a company sells umbrellas, you cannot compare their sales in the rainy season to their sales in the winter. It would look like a disaster, but it is just seasonality. To fix this, we use the year-over-year or YOY growth metric. This compares the current period, say Q4 of this year, with the same period in the previous year. This assumes that the seasonal factors are the same across years, giving us a true picture of growth. We also use metrics like seasonally adjusted growth rate to smooth out the data. To wrap up, let's review the checklist of trends we have covered. First, we have secular trends, which are long-term structural changes lasting 7 to 10 years. Second, we have cyclical trends, which are medium-term waves lasting 2 to 6 years that reverse and return. This includes economic, commodity, and inventory cycles. And third, we have seasonal trends, which are annual, predictable patterns occurring within a 1-year time frame. Understanding which trend is driving the data is the key to accurate financial analysis.